Welcome to Financial Fortitude, where we break down the world of personal finance like a pro wrestler breaking a chair over a villain's back. Quick, impactful, and with a little bit of flair. Woo!
Woo! Today we're diving into a topic that's often overlooked but could be the most important financial decision you'll ever make. We're talking about protecting your biggest and greatest asset. And no, it's not your home, that fancy car, or the secret stash of emergency snacks you keep in your cabinet. It's you, your human capital, and your ability to earn a living.
In this episode, we're unraveling the mystery of long-term disability income protection insurance. What is it, why you need it, and how it can save your financial future when life throws you a curveball. Because let's face it, you wouldn't drive without insurance, so why risk your income without protection?
Buckle up, folks, because by the end of this episode, you'll know exactly how to safeguard what matters most.
Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We are your hosts, Michael Acosta
and Brady Hemmerle. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Michael, let's jump into this thing.
So this topic is something that's definitely important. I feel like a lot of advisors shy away from it and we'll take the easy route out, right? And we'll talk about what the easy route out actually is. But let's break down what long-term disability income protection or long-term disability insurance actually is. Long-term disability insurance is a way to transfer risk to somebody else, typically an insurance carrier. It's a percentage of your income that's going to be replaced in the event that you become too sick or injured to work in your rightful profession or occupation. Everything that we talk about from a financial planning perspective really hinges on our health and our ability to earn income. Would you agree with that?
I would most certainly agree with that. The question that I think we oftentimes ask clients is, or even we ask ourselves, if I can't show up to work next month, how am I going to pay the rest of my bills? How am I going to continue saving the way that I am now? How does my life look if I can't show up to work? And I don't think it's the most fun conversation to have, which is probably why a lot of advisors tend to shy away from it. But it's important because, yes, most of us will keep showing up to work, but there are those events in life that keep us from working and really impact what that cash flow and the income looks like.
No, of course. It's also a matter of just understanding and recognizing, and even more so acknowledging the fact that we're not invincible as human beings. We are all susceptible to things coming up in life, whether it be an illness or an actual physical injury. And most young professionals will overlook this because we believe as young professionals, that story isn't mine. I'm healthy. That's not going to happen to me, right?
I think we all fall trapped to that.
Yeah, we are all susceptible to that mindset. We're here to tell you that we have clients across various age groups that have been exposed or are dealing with some sort of long-term, short-term, total or partial disability. It's a matter of, well, are we preparing enough to improve our overall financial immune system, right? We all have an immune system. And so it's a matter of, are we taking appropriate steps to protect our biggest and greatest asset? And of course, it's not our home if we own a home. It's not our fancy car. And most of all, it's not the precious things that we hold dear to our hearts. It's our ability to earn income. Without it, life looks much more different and it becomes much more difficult.
Yep. So what does a long-term disability actually look or feel like? Because at least when I first got into the industry or when I heard the word disability, even being in the industry, my thought first goes to like, hey, I'm now in a wheelchair because I've gotten run over by a bus of some kind.
And that's most common, right? When we have these interactions with clients and we talk to them about, long-term disabilities, it's usually, hey, I'm in a wheelchair. And then the next rebuttal is, oh, well, I'll still be able to respond to emails and talk on the phone. And it's like, okay, well, that's where your first thought goes. But statistically, 90% of long-term disabilities are actually illness-driven when only 10% are physical injury-driven. And if we're just going to take the top 4 most common disabilities by claim, number 1 is cancer, right? And there's various forms of cancer. So just think about if that were to occur, if you were to become diagnosed with cancer, there are treatments you're going to go through, and some of those treatments are going to keep you from feeling like your best self.
Sure.
So you may not be able to perform at the highest level that you were previously, and that can affect your ability to earn income. Joint and spine disorders, digestive disorders, and lastly, multiple sclerosis. Okay, those are going to be the top 4. from most common occurrence of physical ailments that would require someone to start receiving a disability income benefit.
So that's what we're often telling our clients, right? Is like, hey, I understand that a serious injury could most certainly cause you to get disabled, but 90% of the time, or perhaps even greater, you're not the one getting run over by a bus, right? That's not most client stories. Most client stories are, I'm working, I'm saving, I'm earning, I'm dreaming, and then wait a minute, I've got an illness that I wasn't expecting to have to tackle, or hey, I've got a problem that's keeping me away from work and it's starting to impact my situation.
Yeah, no, of course. And so the next part of this conversation is, well, where do I get this coverage from? Like, if I feel so called that I think that I need to take the next appropriate steps to protect my biggest and greatest asset, to protect my ability to earn income, to protect my human capital capabilities, where do I go and get this?
I think that's a great question. And oftentimes this is what we hear from our clients most, right? It's, don't I already have that through work? Isn't my workplace providing that for me? From a group perspective or group coverage, if you do work as a W-2 employee or you are employed by a bigger firm, a lot of companies will provide some form or fashion of group disability insurance coverage. Go ahead.
And typically this group disability coverage is only going to replace anywhere from 40 to 60% of your annual gross income. Okay? And so for simple math, let's take someone who earns $100,000 a year. If they're only getting 40 to 60% replacement, that means that they're shifting their lifestyle from having $100,000 a year to either 40 to $60,000 a year.
Yep.
That's a pretty significant swing. And we haven't even talked about whether or not the benefit they're receiving is taxable or not, right? And so that's where the difference between group and personal coverage from a supplemental standpoint really comes into play, is just understanding, well, how much income replacement can I get? Because you very seldomly will you have 100% income replacement, right? Because there has to be some incentive for the individual to go back to work.
Yep.
Usually, you have to be mindful of, okay, well, am I paying for this benefit? Or how is the coverage being designed? Because when it's through the group ecosystem, you are limited on how you design it based on your specific needs as an individual. Whereas with personal coverage, you get to pick and choose what features you would like on this policy. And it's taking into account your total income, as opposed to with group coverages, often they're just going to be covering your base salary. So if you're someone who has a combination of income sources between base income or base salary and incentive compensation or commissions or bonuses, oftentimes the commissions and bonuses and incentive compensation are not covered within the language of the contract. And so it's worth reviewing that with your HR department just to figure out, hey, what level of my income is replaced? Because if you make a base salary of $60,000 a year and incentive compensation of another $150,000, well, if you ever had to go on claim, they're only going to replace 40 to 60% of that $50,000 base salary.
Yep.
That could be devastating financially to the outlook of your financial goals and dreams and everything that you're working towards for your family.
And I think that's a shock for clients when we tell them, hey, listen, you're making $200,000 a year, but oh, by the way, if you get sick, a cancer diagnosis, joint and spine, back pain, whatever it is, your $200,000 a year could quite easily, for a limited or even a lengthy period of time, turn into $45,000 a year. That's eye-opening for people, right? It's like, wait a minute, I thought I was covered at work. Well, not quite. Work is stepping in to help out and bear some of the load, but they're really not bearing more or the majority of the load in most of those cases.
Of course, and from a taxability standpoint, if your employer is paying 100% of the group coverage premium, whatever the cost to have that coverage is, then it's very likely that 100% of that benefit, or even a ratio, right, of that benefit is going to be taxable or ordinary income tax rates. So not only, going back to that $100,000 income example, not only are you going from 100,000 gross to somewhere between 40 to 60,000 gross while on claim, but now it's going to be reduced even further because that's going to be taxed at ordinary income. You're slowly sliding down the scale of having less and less income replacement based on the parameters of how group coverage works. And the biggest component that I would say that individuals need to be aware of is, what is the definition of total disability? Because with the disability contract, it's a legal contract between an insurance carrier and the insured, the person who's obtaining and either enrolling into the group coverage or obtaining a personal policy. with group coverage, very often it's going to have what's known as modified own occupation disability definition. And this simply states that for the first 24 months, you as the insured will be considered totally disabled if you are unable to perform the material and substantial duties of your occupation and are not earning income or wages in any other occupation.
Let's break that down.
That's for the first 24 months.
Yep, 2 years only. Let's break that down. What I'm hearing there is if I can't be a doctor, a dentist, a financial advisor for those
architect, CPA,
yep, for those first 24 months, then the group coverage will pay. But after those 24 months, if I can go be a greeter, an admin assistant, anything else where, hey, I'm maybe sick and can still show up and do the very basics, what happens then?
So after those first 24 months, it changes and shifts into any occupation, which is very similar to the definition that's provided or that needs to be satisfied by the Social Security Department's disability option. You have to be so bad off that you cannot perform the material and substantial duties of any occupation. And so it's very limiting. So for the first 24 months, it might be great. You might receive your benefit. But after that, you still have to be so bad off that you can't work in any occupation, which is very difficult to satisfy. So there needs to be a plan beyond those first 24 months. And if you work in a specialty occupation, like a surgeon, like a physician, like a dentist, like a chiropractor, like an architect, whatever it may be, just think about the parameters of your occupation and your skill set. You want a definition that's known as true own occupation. Typically, you're only going to find that in a personal policy, something that you have to go and get yourself. And the definition there, not to geek out, basically states that, hey, if you're unable to perform the material and substantial duties of your occupation, you will be considered either totally or partially disabled, and you will receive your monthly benefit that's due to you, okay? Now, where there's different levels of true own occupation is whether or not the carrier will allow you to work in another occupation or another profession and still receive that benefit, okay? So as an example, we've had clients who, general dentist, was purchasing a practice and needed to have personal long-term disability insurance to collateralize a loan that was being taken out. The young dentist gets into a car accident, injures their hand, is no longer able to practice dentistry anymore. They had to have surgeries on their hand, went on claim for total disability based on a true own occupation definition in the contract, and has since returned back to work as a dental technology sales associate, earning 6 figures in income. So they're receiving their tax-free long-term disability benefit from their personal policy as a supplement to their earned wages in a completely separate profession. That's what you want from an income replacement. You want the most potential income replacement that you can get so that you can continue to implement and work towards your financial goals and dreams.
So, Michael, where do you go to find a personal policy, right? It's easy to say, hey, my work's got me covered for 40, 50, 60%, but now it's time for me to go find a policy of my own, or maybe I'm listening to this and you're like, you know what, I would prefer to be covered in an instance I can't go to work. A Google search sounds a little challenging as to where to start.
Yeah, no, and you could do the Google search, right? If you're a Googler, it's probably going to take you to a bunch of different websites where you're going to type in your own information. It'll likely pull up different carriers. Some of the most common carriers in the industry for long-term disability insurance might be Emeritus, Guardian Life, Principal, The Standard, Mass Mutual, Northwestern
Sounds like
Mutual.
A lot of ads to be coming
a
on
lot
the
of
computer
ads,
screen,
right? It's one of those things where when you submit an electronic submission to a website, you're probably going to get a lot of phone calls from individuals that may be able to assist you with obtaining personal coverage. So one place to start would be to, if you're working with a financial advisor, ask them, hey, do you help with personal long-term disability insurance? I'd love to investigate this.
Yep.
Right? As you work on improving the overall strength and well-being of your financial immune system. This is something that you and I help with. So if there's anyone listening that needs help with at least doing the research and the investigation around it, we're more than happy to do that. But again, there are avenues out there. It's just a matter of figuring out which one is going to align with what level of assistance and guidance you prefer.
And when should those conversations start? Right? Hey, I've been working with a financial advisor for, call it the last 6 months or a year. I've got a financial plan built, or maybe I'm just investigating working with someone. how do we rank the importance of this conversation amongst all of the other planning that, to be quite honest with you, looks and feels a little sexier?
That sounds like a trick question. And to be honest with you, financial planning is more of an art than a science. So every advisor's philosophy is going to be a little bit different. You guys have heard us harp on this in multiple episodes, and you'll continue to hear us harp on this. We believe that talking about the financial immune system should occur within the first 1 to 2 consultations during an onboarding process, right? And it goes back to making sure that you as a consumer, you as an individual, you as a family, you as a business owner, understand exactly what you have, where it's located, how it works, and why you have it, so that you can be prepared for your best and worst days. What's worse than not being able to earn income? And how will that affect your long-term trajectory towards retirement, towards purchasing your first home, towards providing your children with the opportunity to go obtain higher education without having to take on massive amounts of student loan debt, for you to continue to operate your business so that your staff and your clients have somewhere to continue to come day in and day out to receive the services that you offer. So it needs to happen early on from just a due diligence standpoint, in my opinion. And then you figure out, okay, well, one, are you insurable? Because not everybody can get the coverage. Disability insurance is really hard to get because, again, there's a higher probability of individuals going on claim.
Yep.
More than 1 in 4 20-year-olds today will be unable to work due to an illness or injury for 1 year or more before retirement. Right? That's pretty staggering.
Yeah.
That means something could happen to you as an individual.
25% of people are going to go on claim at some point over the course of their lives. That's pretty
Correct.
substantial. Healthy or not, right? That is not, hey, the people who are really dangerous or really sick already going on claim. No, those people don't even have the coverage. They can't get it.
Yeah, exactly. And if we're going to look at all age groups, it's about 1 in every 8 workers will experience a long-term disability that lasts longer than 5 years.
That's crazy.
Okay. And
that's a long
that's
time.
A wide range. Yeah. That is a long time to be without your full 100% income, right? Pre-tax. So it's important. It definitely needs to be a conversation that's had. Again, every advisor is going to have a different opinion on it, and that's fine. They have their right for that. But I hinge on the fact that cash flow drives everything from a planning perspective. And that's a conversation for a different day. So it would make sense that, hey, if my ability to earn income over the course of my working career is my biggest asset, then you would want to insure that just like you insure your home and just like you insure your vehicles.
Yep. And the other challenge, perhaps, or at least the note that we mention to clients many times is we can always go back and fix, repolish, redesign what your investment plan looks like, what your savings plan looks like. You can't go back and rewind the clock on an injury or an illness. You can't say, hold on, let me put a pause on this doctor's visit or this hospital visit because I need to go apply for disability coverage first, right? You can't fix it once it happens.
And that's what makes it tough, especially when working with newer clients, because we just don't know what we're getting into.
Yep.
And so it can be devastating where you're putting parameters in place to take steps to put the coverage in place. And sometimes you don't get the favorable results from the underwriters, depending on which carrier you're applying with. But the good thing is that, hey, you're taking the steps to at least do the due diligence, do the research, and figuring out, hey, what amount of coverage can I get from an income replacement standpoint, whether it's just a standalone personal policy that would be a tax-free benefit, or in conjunction to my group coverage, just to make sure that I'm minding the gap, right?
Yep.
We're going to talk about what minding the gap actually means in the next couple minutes as we start to break down how long-term disability insurance actually works.
So that's what was going to be my next question, or perhaps like where we're headed, is how do we design this thing, right? How do we actually put a policy in force other than the client's going to get a check each month? It's got to be more complicated than that.
No, it absolutely is. And I like to use the analogy that it's a lot like going and buying a car, right? So you go purchase a car, for anyone who's done that recently, and every car dealership, every car line, every car manufacturer has a base package, right? It's just the bare bone minimum of how the car operates and what it looks like aesthetically. Well, they then have different levels and tiers of packages and features that you can include based on the level of comfort you desire when you're driving cross country, or the level of attractiveness that you want the car to look like based on having certain rims, having certain paint, having certain features on the car that aesthetically are pleasing to you.
Yep.
And so when you're designing this policy, the definition of the contract is most important. I'm going to continue to emphasize that. The definition is most important because that's what's going to dictate how you receive your benefit in the event that you have to submit a claim.
That's the safety in your car, right? That's buying a Subaru versus perhaps a Camaro. Not to throw Camaro
Correct.
under the bus, but
Yeah, exactly. And so it's a matter of, okay, I want to first understand what is it going to take for me to receive my benefit, as well as what is the probability of the claim that I submit being paid out, meaning you want to partner with an insurance carrier that has a high probability of paying claims, and you want it to be the simplest process, right? And every insurance carrier is different because they measure and will accept certain levels of risk. Certain insurance carriers have very loose underwriting requirements. Others have very stringent. And it's because they're measuring and analyzing every applicant from a risk perspective before they accept them. Okay, so again, just equipping you with questions and things to be thoughtful of if you're going to take steps in getting personal long-term disability insurance. So step one, make sure you're partnering with a carrier that has a high rating and has a seamless process for getting you the money when you need it if you have to file a claim based on the definition of that occupation. You want true own occupation with the flexibility to go work in another occupation while still receiving that benefit. We talked about modified own occupation. Again, 24 months worth of own occupation definition with limitations on whether or not you can continue to earn income. After those 24 months, it shifts into any occupation, which is very hard to satisfy. And again, that any occupation is very similar to the Social Security disability definition.
Very tough.
Right?
Very
tough.
few people can truly be qualified as disabled through Social Security. It's challenging.
Correct. Very challenging.
How long does it take to start getting the benefits, perhaps? I think that's a big question.
Yeah, and of course, and that's where it's very similar to having a deductible like your health insurance. You're going to opt into an elimination period. If it's a group policy that you have, typically you're going to see 90 days or 180 days. And again, that's designed by the employer when they sign up for this group benefit for all their employees. With the personal policy, you can opt into 30 days, 90 days, 180 days, and sometimes even 365 days. All that really means is that you're willing to accept the ability to self-insure for the first 30, 90, or 180 days and beyond, right? And so from a planning perspective, depending on the individual's overall appetite for transferring risk to an insurance carrier versus accepting it will dictate how much liquidity we need to have on the balance sheet. Because if I can't go to work, then I know that, hey, I need to have enough cash stashed away to cover the first 30, 60, 90, 180 days before my benefit kicks in.
It's what's in your emergency fund, right? If I've got 3 months worth of cash in my emergency fund to cover all of my bills, objectively, my elimination period or deductible could be 3 months worth of time at that point. That's what makes the most sense.
Correct. And then it's a matter of understanding, well, how long will this benefit actually pay out? And what do we see most commonly?
We tend to see most commonly until or up to age 65 or age 67. That's kind of that bulletproof coverage. If I'm 30 or 35 years old, I might get disabled long-term, call it for 2 years, but I might get disabled long-term where I'm never able to return and be a dentist. My hand is injured and I can't do those duties at any point, right? A bulletproof definition of how long the benefit lasts may be until age 65 when I otherwise would have retired. But we can see benefit periods as low as 2 years, 5 years, 10 years, right? And similar to how you're designing your car, similar to the deductible ultimately that you're paying in the elimination period, that benefit period or the length of time you receive benefits just depends on the amount of coverage or the comfort of coverage that you want to see. And you define it.
Yeah, you get to pick and choose. Again, it's like designing your own car or going and picking your own, meal at a restaurant. Right? What all do you want to include in your entree? What are the certain seasonings or things that don't sit well with you, right? That you don't really enjoy. Now, keep in mind, while going through the underwriting process, you might have applied for a benefit period to age 67, but based on your medical history and your overall level of risk as an applicant on paper, they may only be willing to offer you a 5-year benefit, 2-year benefit, or even a 10-year benefit.
Yep.
Now, sometimes it'll lead to reconsideration to where you can reapply for a longer period of time, but it's going to require the applicant to go back through the underwriting process, right? They're just going to want to remeasure that risk based on how life has changed physically.
And occupation-wise. It depends on what you're doing, too. If you're on a construction site, there's large beams swinging above your head. You're more of a risk to the insurance company than the individual who's in a suit and tie sitting in an office chair for most of the day.
Absolutely. Absolutely. So those first couple characteristics we went over as far as definition of the contract, the elimination period, also another way to look at that is your deductible and your benefit period and the monthly benefit amount, because again, you can't be overinsured when it comes to disability insurance. So you don't just get to pick a number out of the sky and, hey, that's how much coverage I want. There's a formula in place, and they're going to take into account whether you have group coverage or if you don't have group coverage. So those are going to be your baseline aesthetics or characteristics of your policy. Well, now we're going to look at some of the additional personalized features that we feel like are very common in designing the overall coverage. So one's going to be partial disability, and sometimes there's an enhancement to it to where, hey, maybe you're not totally disabled, but you just have a reduction in your income by 15 or 20% or more. That's going to be the minimum, 15 to 20% to trigger this feature. Well, what the insurance carrier is going to do is they're going to pay you a monthly benefit up to get you back to indemnity, get you back to what type of income you were making prior to that partial disability.
So let's break that down. This is the rims on your car, right? Or this is the wrap on your car. This is something you add on afterwards. I'm working full time. I'm self-employed. So every day I go to work, I'm responsible for the money that I earn. I get sick, and I can really only comfortably show up to work and give it my all 3 out of the 5 days. On a Monday, a Wednesday, and a Friday, I'm at work. On Tuesday or Thursday, I'm at the doctor's. I'm in therapy. I'm kind of not focused on my day-to-day job. I'm losing income at that point. Right?
Correct.
Whether I want to admit it or not, I just can't work those other 2 days.
Correct. And so this would kick in as long as we're able to prove that, hey, you've had a reduction in income by about 15 to 20%.
Yep.
Another one, cost of living adjustment. This is huge because we've been working through an inflationary environment for the past couple of years, right? Historically, inflation is going to be in range of about 3 to 4%. Now, with certain carriers, they're going to offer a cost of living adjustment while on claim, to where the benefit the insured would receive will increase by a percentage. Most commonly, we see 3%. Okay, compounding, sometimes it's fixed. It really just depends on the carrier and how the contract is actually written out. Another feature would be future increase option. Okay, FIO for short, for those who are in the medical field and have people that come in and speak to you often while in residency and training about, the importance of income protection. But this is the insured's ability to lock in their insurability today with the opportunity to buy more disability coverage in the future without having to go through any medical underwriting, which is huge for some. And we've seen it in many instances where, the young medical professional is in residency or training, healthy. They set up their policy with a base benefit plus future increase option, and something happens while in training, and they need to get more coverage before going on claim because of the treatments that they're going to be receiving. And so they can do that as long as they are eligible from a financial underwriting perspective, because again, you cannot be overinsured.
So you're a resident, you're making $60,000 to $70,000 a year. You're young, healthy, and bushy-eyed, perhaps. And then you go through residency, maybe you put on a few pounds, you're a little more tired than usual. You get into an accident, but now your income instead of $60,000 to $70,000 a year is $200,000 to $300,000 a year. You can step your coverage amount up in the event of an upcoming disability. Go and buy more coverage to say, you know what, my income supports it, but that young, healthy guy that bought the coverage before, that's who's the guy who is getting the payments.
Absolutely. And there might be limitations in the contract with when you need to execute the future increase option before it's removed from the policy.
Yep.
Right. Typically, that's going to be around age 55. Another reason why you might opt into triggering a future increase option and getting more coverage would be if you change your employer and your new employer doesn't offer group coverage. Well, now you want more income protection because you recognize that, hey, my ability to earn income is huge. It's important. It's vital to my financial success. I want to make sure I'm replacing as much of my income as possible. So I'm going to go ahead and execute this future increase option.
Yeah. And let's look at that. Let's jump straight into an example here as we kind of wrap things up, right? As oftentimes we're hearing, I've already got group coverage. Do I really need the extra income or the personal disability coverage? And the example that we use here, where we found in a specific client scenario, is we've got a 28-year-old female pharmacist earning approximately $142,000 annually. That is gross. So each month before taxes come out, she gets paid about $11,800. Right? If we assume that she makes all of the money, doesn't get disabled through the entire course of her career, it's quite possible that she earns $10 million or more, assuming that each year she gets a small raise. That's huge, right?
Yeah, no, that's sizable, right? And again, biggest and greatest asset, because when reviewing this individual's balance sheet, nowhere on there was there already $10 million.
No,
right?
No. Very few circumstances that is. How about we'll say that.
Yeah, especially for a 28-year-old, right? Assuming they're going to be working to age 67. Let's just kind of lay that out there. Well, from a group coverage perspective, this individual's employer offers 40% replacement of base salary coverage. Okay, so again, making $142,000 gross, which is a little over $11,800 per month gross, to if this individual had to go on claim, they would start receiving about $56,800 annually pre-tax. Okay, that comes out to about $4,733 per month. That is a significant decrease in income.
It's about $100,000 almost.
It's massive.
Yep.
And
the difference there really is in the wealth building potential. This individual earns her full salary each year, and through the course of age 65, she may have made, depends on how much she saves, but she would have made $10 million. She gets injured next year and has to stay on claim until 65. Through that same time frame, now she's only making about $4.5 million. There's a $5 million difference with only having group coverage. I think I'm covered with my employer, right? I don't know. You tell me, is that $5 million over the course of your career meaningful to the goals that you have, the life that you're looking to build financially? For a lot of individuals, it is, right?
Yeah, no, that's significant. And this is where we get into the idea of mind the gap. It's what am I losing between my group coverage and what I'm able to earn while I'm healthy? And that gap is typically what you want to get supplemental personal long-term disability income protection for. You want to be assured that, hey, my group coverage, assuming I'm still working for my employer when a disability occurs, is going to pay me X. I want to try to replace that delta, the difference between when I'm healthy and what I'm getting net of any tax if my employer is paying for my group benefit. Because we already talked about the taxability of it. So in this scenario, this individual, this young lady, has the opportunity from a supplemental standpoint to obtain another $4,470 in tax-free monthly benefit. Now, the reason why it's tax-free on the personal side is because you're paying for the premiums with after-tax dollars.
Yourself. You're paying yourself.
As an individual, right, from your take-home. Usually with group coverage, they're deducting it from your paycheck pre-tax. There are some instances where they will deduct it post-tax, or they'll give you imputed income. Will they pay you the premium and then they debit and deduct the premium from your pay? We offer this analysis for clients when going through a pay stub analysis to be able to confirm, again, this is what you have, this is how it works, this is why we have it, and this is what you can expect. With that supplemental group, if this individual had to go on claim, again, there was a gap of potential wealth long-term, a little over $5 million from group coverage to being healthy and working a full career. With the supplemental coverage, we're able to dwindle that gap down to about $2 million in difference. That's a lot easier to stomach from a financial planning perspective long-term versus $5 million in lost potential wealth. All because we did not take the appropriate steps to be proactive in doing the research and the due diligence as to whether or not it made sense for me to have supplemental personal long-term disability coverage.
Yeah. I know someone will step in for me, for my family, to help pay the bills that I can't pay anymore if I'm not working.
Absolutely. And another way of putting that would be, do you want to put your financial future in the hands of your friends and or the potential friends that you think that you have that would contribute to your financial well-being? Because even if an individual became disabled and they fell into financial hardship, I imagine friends and family would step in. But how long will that last?
Yep.
And how far will that go before it's not enough? When it comes to reviewing and managing your financial immune system, income protection is a very important one. And it's not the most exciting conversation, as Brady mentioned early on in the conversation, but it's an important one. No different than, making sure that your defense is adequate to be able to hold off the opponent's offense so that you can get your offense back on the field.
Yep.
Right? The old saying is that Offense puts fans in the stands, defense wins championships. Same concept with your financial well-being. Let's make sure that you have a moat around your financial fortress so that in the event there is an attack or an assault on your financial well-being, you're protected, you can withstand that, and you can continue to plan forward, implementing and working towards the goals that you've shared with your advisor, getting you closer, prepared for a future successful financial retirement and being able to enjoy the fruits of your labor.
Yep. Well, Michael, I think this was great. Anything else that you had?
No, at this point, I think it's, again, important. Understand what your biggest and greatest asset is. If you have questions about whether or not you think supplemental personal long-term disability insurance is right for you, speak with a professional that you trust, someone who's typically licensed and has the competency to understand how long-term disability insurance works. But as always, if you find this episode to be helpful, please like and subscribe wherever you listen to podcasts. Also, be sure to share it with your friends, family, and colleagues. For more valuable insights, visit us at www.genesiswealthplanning.com/podcast. And thank you for tuning in.
See ya. Thank you for joining us this week on the Financial Fortitude Podcast. We hope you enjoyed the show and learned something along the way.
If you're looking for financial guidance that is personalized to your specific needs, we're here to help. Visit us at www.genesiswealthplanning.com to book a complimentary consultation.
That's it for today. Make sure you subscribe so you don't miss out on future episodes. And as always, please share with others you feel could benefit from the show. See you next time.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Acosta and Brady Hemmerle are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerle's California Insurance License Number 4353077 7012070, period 1, expiration 926.